What's going on? Alex here, and I'd like to welcome you to yet another Efros Financial Power Hour live stream. So pull up your favorite beverage, lean back in a comfortable chair, grab your dog, grab your cat, let's hang out and let's talk finance, because that's what we do here every Wednesday, 7 p.m. Pacific time, 10 p.m. Eastern time. And with that, we're going to jump straight to some Reddit questions. We're going to take a bit more of a financial planning lean on this live stream as opposed to the taxes that we've been hammering for the last few streams. And it should be a good change of pace to take a bit of a different perspective on the financial world. And as we're going through these questions, if you have questions, drop them in the live chat down below, and I'll do my best to answer them. I don't know everything, but I'll give it the good old college try, that I can promise you. And with that, let's take a look at our first question. And this question is from the personal finance subreddit and comes from Moonraker and goes as follows. My dad's financial advisor wants him to sign up for life insurance for my kids as an investment. Is that legit? Oh boy, I think some of you already know my feelings on this, but let's keep reading. My dad wants to build up some sort of fund for them to save some money when they come of age. Apparently, his financial advisor suggested this life insurance thing. The gist of it, as I understand it, is that he will pay a monthly fee, and when they turn 18, they'll have the option to cash it out or keep it going on their own. It sounds strange to me. Is this legitimate? If so, what are the potential pros and cons of this versus a normal investment account or a 529 plan? And down here, there's an edit which says, apparently, it's a fixed index universal life policy. All right. Coming from the perspective of a fee-only financial advisor. Now, fee-only has a very specific connotation in the financial planning world. And it means that you do not accept commission for the sale of financial products. It's a very important point. I'll say it again. As a fee-only advisor, you cannot receive third-party compensation for selling any sort of product to your client, which means the only revenue you receive as a fee-only financial advisor is the fee that your clients pay directly to you. So it's not coming from a mutual fund as a kickback. It's not coming from annuity as a behind-the-door payment, under the table, whatever you want to call it. It's not coming from a life insurance company that is rewarding you for selling policy A over policy B. Fee-only model allows you to align as an advisor the interests of yourself and your client, right? So your client benefits from the advice that you give them, and you receive a fee. Everybody wins. On the other side, you have financial advisors who are not fee-only. And there are two distinctions that they go under. They're either commission-based, which is pretty upfront in that they receive a commission for selling a product. Nothing wrong with that by itself, but you have to be aware of the fact that that's who you're dealing with. So when you walk into a car dealership, you're not expecting the salesperson to advise you on which car is best for you. You're expecting them to sell you a car and make a commission, right? So you know that the advice that you're going to receive is going to be biased, right? Because if you walk into a Honda dealership, they're not going to advise you that you need a Toyota, right? And if you go to a Toyota dealership, they're not going to advise you that you need an Acura, all right? So with that, you have to take the personal advisor, financial advisor roles with a huge grain of salt, especially if they're commission-based, okay? The other designation that they tend to go under is what's known as fee-based, not fee-only, fee-based. And we encountered a lot of these advisors when we were working as fee-only advisors, and you'd be hard-pressed to figure out how they function, right? Some of them are registered as a fee-only advisor under one firm, and then they're a commission advisor under another, and good luck trying to figure out which one you're working with at any particular point, okay? Because it's not set up to be very clear when it's fee-based, okay? So you have commission, you have fee-based, which nobody knows what that really means, and you have fee-only, which is a very specific distinction within the financial planning world, and that means, if the person is being forthright and honest, that there's no third-party compensation, no commission for the sale of financial products. Why do I get into this rant? Well, the reason is that so many times as a financial planner, we get clients coming on board and they present their financial situation to us, right? So they'll have some assets, liabilities, income, expenses, and we take a look at the overall picture. And so many times, these clients come through with what I can only describe as a hodgepodge of investments and other assets that they've accumulated over the years that even they don't know why they own. All right? So imagine you're walking down the street and you see a car parked by the curb. And this car is 7 different colors. It's missing a wheel. It's got only 3 wheels. The windows are all smashed in. And the body looks like it went through one of those car compactors and then somebody pulled it back out to try to have it resemble a real vehicle. All right? So really sad looking car, but it's got these amazing, gorgeous, shiny, fancy, expensive rims on those 3 wheels. What do you think when you see that? Right? It raises some questions, does it not? The whole body of the car is in shambles, yet it's got these $5,000 a piece rims. That's exactly how we picture these clients that come over that worked with so-called financial advisors, and they've been sold a bunch of crap over the years, and now we have to unwind it and figure out why they have a life insurance policy, why they have the annuity, why they are invested in all these different mutual funds, paying enormous fees for the privilege. Often, it has to do with the fact that somebody sold them this stuff on commission. Because a fee-only advisor would never put together this hodgepodge of random assets and investments, right? This had to come from a brokerage, had to come from a commission-based sales person. This drove us nuts because these were good people. They didn't even know in many cases what they were pushed into, but they'll have all these different financial products that don't make sense when you consider their overall financial picture, their overall goals, and everything else. Looking back to this situation, we see that this is exactly what happened. All right? Let's do a little quiz. What is the purpose of life insurance? Right? At the end of the day, is it an insurance product? Is it an investment product? Is it a little of both? Well, you have to understand the way life insurance works, right? So the insurance company is willing to sell you a policy and they're going to take your money. Okay, so they have that money. Where do they go with that money? It's very clear. They go to the stock market and they invest that money and let it grow over time. So here are you. Your money is given to the insurance company. The insurance company invests that money in the market. And they take a cut, of course, right? Because they have to make more from the market than they're going to pay out in terms of the death benefits on the life insurance, right? So that means that just by the nature of how that's set up, you as the individual are essentially guaranteed in many cases to get a lower return than what the market will pay out. Again, generality, but the only way for this to work is for the amount of the life insurance proceeds that they pay out to be less than the returns they make from the market, because that spread is their revenue. So think about it that way. Now, if you were to simply take that money and invest it over time, well, what's happening? Well, you're skipping the middleman, right? So your fees or premiums go into the market instead of the insurance company. You're able to participate in that upside. So instead of the insurance company investing on your behalf, you're making the investment and getting all of the returns. And then you can use those funds however you want. And the best part is, nobody has to die for you to receive those proceeds. On the other hand, if an individual who's insured does not die while you have the policy, well, guess what? In many cases, you lose all those premiums. Depending on the type of insurance product, there are very many different types. But again, in general, that's what happens. So, as soon as a financial advisor starts telling you that, hey, this life insurance, this is a great investment, kick them out of your house. Walk out of the office. They're lying to you. In the vast majority of situations, whole life insurance makes no sense. You may end up paying not 3 times, not 5 times, not 7 times, but 10 times for a whole life insurance policy than you'd pay for a term policy for the same amount of coverage. All right? And I know there's a lot of insurance salesmen out there that might be watching this at some point, hitting that down vote button and saying, oh, wow, there's so many different types of products. I'm talking about in general, the vast majority of cases that have whole life insurance shouldn't have it. Period. So let's go back to this situation. I asked a little while back what the purpose is of life insurance. And the insurance part of that is an essential focal point. It's meant to replace the income that you would have received throughout your life, right? So if you have two married spouses, each one of them theoretically has earning potential, right? So if both of them were to live to age 100, then they would make income most likely until retirement age for very many people, right? So that's where the majority of their income is going to come in. But let's say that one of them passes away when they're 30, okay? So that income that would have been earned from the time that they're 30 years old to 65 now goes away. So as a family that's left in that situation where that income earner is no longer alive and creating income for the household, how do you replace that income? That's where life insurance comes into play, and it replaces that income that would have come in over whatever number of years the person had left in their working life. That's the point of life insurance. It's to replace the income that would have come in. It's not a lottery ticket, right? You're not just looking at the sick guy down the block and going, oh, he doesn't have a lot of time, I might as well get a bunch of life insurance on him. No. This isn't Vegas. It's life insurance, right? So if you're approaching life insurance from the perspective of, I'm going to make a killing from this as an investment vehicle, you're doing it wrong, A. And B, you're buying into the hype that the insurance salesman has created. Because they're talking about, oh, well, the market can do this, and our policy does this, and you're missing out on the volatility and all of this, you have less stress, and they make it sound great. But at the end of the day, that prospectus, that document that you're going to have to read through and agree to when you sign up for that policy is going to be sometimes 50 pages, 100 pages, 150 pages. And great things usually don't require 150 pages to explain, right? It's usually pretty straightforward. Like the best food is usually made from the least amount of ingredients. Real simple stuff, right? Take a steak, throw some salt on this, some pepper, throw it on the barbecue grill. You're good. So, same situation applies for financial products. So, if you're talking about life insurance on kids before they turn 18, what are you even doing? They wouldn't have earned any income at all. So what you're banking on is paying in to that life insurance and then getting a higher amount over time. But let's not forget that they're a middleman between you and the market. So they're going to give you maybe some of that policy back in terms of the premiums, but in 99.9% of cases, you would have been better off if you had simply invested that money on your own, be it in a 529 plan or not, and let it grow over time. Because you've got time on your side, you've got compound returns, it's a beautiful thing. So as soon as I see that someone under 18, unless they're a child star and they're in the movies, making millions upon millions of dollars, this makes no sense. So as soon as I see that there are children with life insurance policies, I know that that was done by a commissioned salesperson. It's unacceptable. And it shouldn't be the case, all right? That's a surefire way to determine you're dealing with a broker, because a fee-only financial planner would never put you into this, all right? Okay, so hopefully, Moonraker, this adds some insight to this situation. Run, don't walk from this financial advisor. Run, okay? All right, and if you're hanging out, you're liking the content, like the video, would you? Subscribe to the channel. Leave a comment down below. I don't bite. And we're going to move on to the second question of the day. This question comes from Fool on a Hill and goes as follows. Is there such a thing as a financial coach? I told you guys we're going to be on the financial planning theme, and here we are. Like a gym trainer or someone who can just motivate someone to get their finances in order. I come from a poor family with terrible financial habits and lots of bad debt. I have no role models or mentors when it comes to managing finances. Despite having no support or literally anyone in my family who knew anything about going to college or having a decent career, I managed to rise above get a degree and a stable corporate job with good benefits, and pull myself into the middle class. That's a wonderful thing. Okay, everything I'm reading there is pure goodness. Let's continue. I probably have some mild PTSD from going negative on my bank account all the time, working on my way through college. I'm terrible at caring or trying when it comes to budgeting, investing, managing debt, you name it. Does this sound like anybody watching right now? If so, let me know in the comments below. My situation isn't terrible, but it isn't great. 29, male, have about $7,000 in 401k that I haven't contributed to for a couple of years, despite a 5% employer match. That kills me a little bit inside, but let's keep reading. $4,000 left on an auto loan, $11,000 in student loans, $75,000 in student loans for the spouse who just finished their master's. Again, these people are killing it. And I make $80,000. She stands to make $40,000 for the foreseeable future. No kids for now. We just got out of an expensive lease and are moving back rent-free with my wife's family to recover financially for a bit. All right. It feels like a good time to get things in order since I don't have the stress of paying rent for at least the next 6 months. I'm just terrible at doing this stuff or caring. I know I can do everything on my own without an advisor, but it's similar to how you exercise on your own, but a trainer can help you in terms of motivation. It helps keep you accountable and offers specialty knowledge. All right, so this situation is sort of similar to the other question in that, again, we're getting into the world of financial advisors, financial coaches, and I will tell you that the financial advisor world is full of scam artists, but the financial coach world is even more so. These people will come from all walks of life, and I can guarantee you that every one of them is going to have something to sell. Okay? Especially if they call themselves financial coaches. Now, with that, working with a fiduciary fee-only planner in this case may have some benefits. I'll share a story with you. As a planner, I received a call from an individual who was a physician, a successful one at that, doing really well. And this person told me, hey, Alex, you know, I make $500,000 a year. And when I start the year, my bank account's at $3,000. And when I end the year, my bank account's still at $3,000. And I just don't know where the money is going. I want to be able to save for retirement, put money away, all this stuff. But every time I try, it seems like the money slips out of my hands. And I just don't know. My expenses aren't that high. I don't know where it's going. And I said, okay, let's take a look. And I asked this person for a list of expenses that they paid on a monthly basis so we can understand how the money's coming in and how the money's going out. So I received the information. I went through it. So there was $500,000 coming in. You subtract what you need to for taxes. You subtract living expenses, retirement plan contributions, all this other good stuff. And we should have $150,000 left over. I'm just using made up numbers, but you understand the idea. So I asked, where is $150,000 going? And I didn't really get a good answer because a lot of this is very personal. It's very difficult to turn the mirror on yourself and understand that some of the habits that you're engaging in are not healthy from a financial perspective, right? It's just like somebody who's addicted to gambling or someone who's addicted to alcohol, right? People can be addicted to spending and they become accustomed to a lifestyle that they are fearful of losing. So I said, okay, we're going to do a deep dive here, all right? Which means we're going to take your bank records. We're going to take your credit card records. We're going to get into the details and understand every single transaction, classify everything, understand what's going in, what's going out, and assess exactly why you aren't able to save. And there's no savings happening. And we went through that process. Sometimes you have to get down into the weeds, all right? And it's time consuming. We were working with Excel, linking spreadsheets together, getting bank statements, credit card statements, all of that. And we determined that there was a lot more money going out that this person was aware of. Again, smart individual, very astute. They were able to get through medical school, but sometimes the financial side just doesn't ring a bell with people. All right. And for this individual, we were able to turn things around because we were able to point out, hey, this has to stop. This has to stop. By the way, you're used to doing this, right? It's got to stop. Your lifestyle is going to be adjusted, and it's for your own good, all right? You're going to live the lifestyle that you can afford, all the while saving for retirement. And I can tell you that the next year, there was over 6 figures in that bank account that used to have $3,000. And I'm not patting myself on the back as if I'm some sort of superhero, but I can tell you that this person's life was changed around by a little bit of coaching. They did all the work. They did all the hard work. I didn't really do anything that crazy, but you're able to just shine a light and then gently nudge a client in a particular direction. And that's the beauty of financial planning, financial coaching, what have you. It's that sometimes that difference in perspective is all you need to get the train moving on the tracks in the right direction. But you should always be aware that the financial coaches out there, in many cases, are going to try to sell you something. They're going to have a product. They're going to have a book. They're going to have a course. They're going to have a series of videos that they need you to watch. And then before you know it, you're subscribed to some sort of crazy, expensive financial planning, what have you. That doesn't need to be the case, all right? If you're going to pursue the services of a financial planner, financial coach, then quite simply work with a fee-only financial advisor, okay? If they're a certified financial planner or CFP, even better. Now, CFP is kind of funny in that it doesn't always denote that somebody's a fiduciary, which is a little bit strange. But if someone advertises themselves as fee only, they are certified financial planner, CFP, then you should be okay. If they're a CPA on top of it, I would consider that to be even better because CPAs are highly regulated. There's a lot of rules in place, and it's not like any Joe Schmo can just wake up one day and decide they're a CPA. There's a process to go through. So certified financial planner, fee only, and they're a CPA, you should be good in terms of getting some hourly planning done without having to sign up for some crazy scheme or course or sessions where you have to attend over and over again. This could be a one-time thing that can right the ship and have your financial situation actually geared towards achieving your goals. What a concept. All right. And that's what I would advise in this situation here. So fool on a hill. In this case, there's a lot of good that's happening. There are assets, income that are going to build over time. You just have to determine what your goals are, and you have to kick yourself in the butt a little bit by getting a good financial planner working with you to make sure you can get there. All right? Just like the situation with the physician, okay? Who knows where that person would have been if they didn't ask for a little bit of help. And the funny thing is, they still did all the hard work. They adjusted their lifestyle. They had to take the initiative to get a planner involved. And at the end of the day, it paid off. So it's a win-win. All right? That's what I have to offer for this question right here. All right. And a good question comes in from Lewis. All right. I love when you guys ask questions. And if you're watching right now and you got a question on your mind, drop it in the comments down below. I don't bite. All right. So now we have this question here. All right. So, and Lewis, thanks for watching. I appreciate the question. It goes as follows. What's the point of financial advisors when we have index funds? All right. That's actually a poignant statement because there is the concept out there that if index funds exist, there's no room for financial advisors, right? What are they going to advise you on? Well, you'll be amazed how emotional people can be. And sometimes when they're invested in an index fund and the market dips down 30%, they freak out and they say, oh my God, that's too much downside exposure. I don't want to lose all my assets. And those clients switch to a bond-based or a fixed income index fund right when the market's at the very, very bottom. Then what happens? After every downside move, especially the drastic ones, the market tends to shoot back up at some point, whether gradually or all at once. And that person goes, wait a minute, I'm missing out on all of these equity returns. Let me switch out from these fixed income funds back to equity. So they'll switch again. And they'll continue on that roller coaster because they're emotional. They don't understand the overall financial situation that's applicable on an economic scale. And they're not looking forward. They're not thinking about 5 years from now. They're not thinking about 10 years from now. They see the balance in the account decreasing and they freak out. That's where a good investment advisor can come in, because when they receive the phone call from the client frantically saying, sell, 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 and I've been in this position, we had to explain, hey, here's what's happening, all right? Right now, we're experiencing some downside. Yes, this is going to happen when you have equity exposure. This is what you signed up for. But we also need the discipline to understand that when we zoom out of that stock market chart, right, it tends to go up and to the right. You'll have the little valleys in there, but overall, if we're on a 30-year time horizon, which our clients, when we work with them up front, we determine, what is your time horizon? Do you need the money in 10 years, 20 years, 30? Oh, 30 years? Great. In 30 years, I guarantee you, nobody is going to remember that this dip in the market even happened. And what you don't want to do is handicap your future returns by being too emotional. And that's where financial advisors can come in, even when there are index funds available. Aside from that, it's good to be able to allocate between equity and fixed income. And some clients out there, they want market returns, but they don't want to lose any money. They'll often say, look, I want 15% a year in terms of the returns, but if it goes down $1, I'm going to freak out. Well, for that client, as a professional, you'll be able to steer them away from full-on equity exposure and say, look, clients are always concerned about the returns. As advisors, we're concerned about the risk. Because if you want 15% returns, but you can't stand to lose a single percent, or you freak out and you lose sleep, pull your hair out, then it's not going to work. We need to align the interests and goals of the client with the behavior of various financial instruments, right? So if they want full-on equity, they want 15% upside, they need to be able to deal with 15% potential downside. Risk and return are related directly. So in that case, you might say, hey, if you could stand a little bit of volatility, we might do 60% fixed income and 40% equity. In that case, you still get some of the returns, but you don't get the roller coaster ride that the market would otherwise offer if you were full-on equity allocated. That's where a financial advisor can also come into play. So it's in keeping the emotion at bay, understanding the risk and reward characteristics of the client, and also rebalancing that portfolio over time. Because again, if you have half fixed income and half equity exposure, over time, those values are going to drift. And let's say in a particular year, the value of the equities increases substantially. So now you're no longer 50-50. You may be at 70-30. So your portfolio, by just allowing the returns to occur over time, has become more risky. And some clients don't have the time or don't have the knowledge to see that or understand that. So they still think they're 50-50, but they're at 70-30 because the market value's changed. Very common. So a financial advisor or investment advisor, whatever you call it, will rebalance periodically, usually on a quarterly basis, to make sure that we keep that 50-50 allocation. All right? So my perspective, and people may disagree, is that it's good to have financial advisors even with index funds. The two can coexist. All right? And the last part of this is that I'll say a good financial advisor is needed when you have a high net worth. I partially agree with that. I partially disagree, respectfully. Because I always said that if someone has a lot of money, they need a financial advisor. But if someone doesn't have a lot of money, they need a financial advisor even more. Why? Because they need to have less, do more. They need to have what they have in terms of income and assets go that much further. All right? Financial planning with somebody with $100 million, in many cases, is easier because, let me just preface the statement, in a situation where they lose $500,000, they're still good. But for someone where that $500,000 is their last $500,000 that they own and they want to go full on into the market and they're 56 years old, that's a scary proposition, all right? Everyone at the end of the day could benefit from having a good financial advisor, because I have clients that have negative net worth, meaning that their student loans are so large that it exceeds the value of their assets and then some. Those clients benefit tremendously in some cases just from seeing the different pay down schedules. I did a video recently on student loans and the true cost of the income-based repayment plans. Check that out if you'd like. But even in terms of changing the payment amount that you pay on a monthly basis, you can change a 25-year pay down schedule to a 10-year pay down schedule. And being able to visualize that is extremely important. So I would disagree with the fact that you need a high net worth. Even people with zero or negative net worth can benefit from a different perspective. All right, and that's what we offer. All right, so hopefully that answers the question. Lewis, thank you for your question. Now, we're going to switch over to question number 3. And if you're still hanging out, feel free to smash that like button, subscribe to the channel, and we will move on to the next question from Reddit. And that is, meeting a CFP tomorrow and need advice. CFP certified financial planner, and I've already vetted them. Okay, so we're past that. We're assuming that this person is qualified and they're fee only and they've got this person's best interest in mind. All right. I'm at a loss as to how I'm supposed to plan for retirement as a 34-year-old female. I know my husband's retirement age goal. I know we're high income, but with debt. I don't know what state we'll retire in. I don't know what tax bracket we'll be in. What if we get divorced? Statistically speaking, love you, boo. I like that. He is the breadwinner and I stay at home. Should I treat my investments differently to protect myself? Who knows what the tax rates will be then? I've taken the task of this project on and I've researched and still feel at a loss on the overall picture. I've read all the terms and options and know the gist of what I need to accomplish, but it still feels like I'm trying to predict the future. Okay. This is a situation that we'll commonly find clients in when we work with them for financial planning. And the issue is that everybody wants to plan for retirement. But what's often neglected is the fact that the word retirement doesn't mean anything. What I mean by that is retirement for you is different than retirement for me, is different than retirement for the next guy. And ultimately, you want to understand whether retirement means working 3 days a week at the company that you own and spending the rest of the time racing cars in Florida, or spending 6 days a week on your boat and spending 1 day a week just coming into the office and collecting your check? Or does it mean living off your investments and just spending the day painting? Everyone has a different perspective on retirement. And often in financial plans that I've read, they just click retirement and that's what they plan for. Wait a minute. Did you take the time to ask if this client wants to just live off of the income from their investments? Did you ask if they wanted to start a company? Did you ask if they wanted to move to a different state? Did you ask if they want to stay in the country? How many kids they're still planning to have? Are they planning to save for college for those kids? Are they planning on buying rental properties, selling businesses, moving across state lines, purchasing and selling residences? All of those variables need to be taken into account to understand what you're working towards. So the first step that we take in the planning process is we actually say, hey, talk to me about what retirement means to you. Okay? And from there, you can work backwards. It's not always the couple walking down the beach with the gray hair with the sunset. We've all seen the commercials, right? That's what everybody assumes retirement to be. But we can't generalize it, right? Because once you go through the work of putting together a detailed, comprehensive financial plan, the client tells you, that's not my goal. You never even bothered to ask. So what we did in the investment firm that I worked in, where we managed about $300 million for clients who we did financial planning, is we started with that retirement picture, getting a good picture of what we're working towards. And after all that work is done, often we'll have an income amount, right? So you'll make 200,000 or 300, 500,000 a year, okay? That's the lifestyle, that's the retirement that you're looking for, and that's the amount of income that'll allow you to enjoy that lifestyle. Now, once we've established that, we work backwards, okay? And we think, okay, how much do you have to put away every year to have your portfolio grow to that point where you can enjoy that retirement that you want? Not the retirement from the retirement plan brochure with the gray-haired couple on the beach. No, your particular retirement. How much do you have to work and until what age for you to achieve your ideal retirement? All right. And what risks are there that jeopardize that particular goal? And this person is already very astute. They mentioned the fact that there are some variables here that you'll have to take into account. Specifically, what are tax rates going to be? All right. And that's one variable. And the way we address that is we say, hey, in general, over time, we've noticed a trend with tax rates, and they don't tend to go down, they tend to go up. And then we ask the client, would you agree that in the future, tax rates may tend to be higher instead of lower? And the client will tell you either, yeah, that sounds reasonable to me, or no, that's crazy. And that is yet another variable that we can manipulate in a comprehensive financial plan so that that's already accounted for, right? So we could say, hey, if tax rates increase, then instead of having $3 million when you retire, you might have $2 million. Does that put you outside the scope of that ideal retirement? Do you now only afford half of that in terms of the income that you're going to make? Those are the variables that you can put into play. But as another measure, we could say, hey, instead of trying to predict the future, let's be proactive in terms of making sure you have various buckets of assets with different tax treatments to protect you if our assumption does not play out. Let me give you an example. Typically, when we do financial planning for clients, we want them to have 3 buckets of assets, right? The first bucket are the taxable assets, right? So you'll have the brokerage accounts, you'll have the bank accounts, trust accounts, any non-retirement type of account that's taxable, which means that if there's dividends, they're taxed. If there's interest, there's tax. Capital gains are taxed. Okay, so your typical brokerage account, bank account will fall into that taxable category. So if you have some taxable assets available, that's great. The second bucket is the pre-tax assets. So those are your 401ks, your IRAs, right? Accounts that are typically retirement accounts contribute to on a pre-tax basis, which means you received a deduction, okay? So that could be a SEP plan, 401k, IRA, all those different types of qualified retirement accounts fall into the pre-tax category. That's the second bucket. The third bucket are the post-tax amounts, or these are the Roth amounts. These are the non-deductible IRA contributions. So retirement plan contributions, they're tax qualified, which means they get preferential treatment. They grow tax-free typically over time. And they were contributed to on a post-tax basis, which means that you did not get a deduction in the year in which the contributions were made. So you have the 3 different buckets: taxable, qualified retirement assets, meaning the pre-tax assets, and then the post-tax assets, which are the Roth and non-deductible IRA contributions, things of that nature. Having those 3 buckets of assets allows you flexibility, because if Congress decides 20 years from now, hey, by the way, we're going to tax IRA distributions to death, okay? So if you take a distribution out of your IRA, we're going to tax that bad boy at 60%. And we go, whoa. Instead of trying to predict that 20 years ago and putting all our eggs in one basket, what did we do? We made sure that we had 3 buckets of assets available. So now, if getting money, according to the new rules, is extremely costly in terms of the pre-tax assets, in terms of the 401k and the IRA amounts, we can take funds out of the taxable assets in a tax-qualified manner, which is more efficient, all right? Instead of having to dig in and deal with that 60% rate. Likewise, in many cases, we could also take advantage of those post-tax assets, the Roth, the non-deductible IRAs, and so forth, which again gives you that flexibility of navigating uncertain waters. And that, in many cases, is how we reduce the risk in financial planning. It's not that we try to roll the dice, and if we're right, it's great. If we're wrong, oh, I guess the client's screwed. Congress acted differently than what we expected, so we're going to just burn everything down. No. Smart financial planning involves knowing those risks, discussing them with the client, hashing them out. Sometimes you got to pull this stuff from clients, right? They won't just give it to you. They won't just spill what's keeping them up at night. You have to pull it out of them, okay? But once you get those details, then you can understand how to mitigate that risk. That's where the value comes in, right? So the 3 buckets of assets is a beautiful thing, and clients will often hear that and go, wow, that makes a lot of sense. I like what I'm hearing here. And then they start to relax and their shoulders come down. And they understand that this solution makes sense in so many different ways that they then get more confident in the overall financial plan, and they are more engaged and participate a lot more. So the other variable that was brought up in this situation is that of divorce. It's very important to take into account, and it's not a comfortable vibe in the room. Oh no. When you bring up a divorce with a married couple who's happily married at the time. But it's a conversation that you need to have, because people don't hire us to have comfortable conversations. They don't hire us to have fun conversations. Sometimes we just need to lay it out and have a real conversation, even when it comes to divorce. Often this has to do with assets that are separate and then commingled and all of this. So what I'm talking about there is that in a community property state, which California happens to be, if you get married and you start accumulating assets, meaning through income, through investments, purchases, and so forth, that tends to be community property in many cases, which means that if there's a divorce that happens, it's split 50-50. Again, that's a tremendous generalization, but in a community property state, that's how it tends to play out. So the question is, are both parties comfortable with that potential outcome, or do they have to do some planning to ensure that it doesn't play out necessarily that way? Now, again, I'm not a divorce attorney. This stuff can get nuanced. You can go to law school and get 10 years of experience and not know your way fully around this area. But what I'm telling you is that these are real variables that we have to discuss. On one planning engagement, I was working with a couple and they had significant student loans. Okay, we're talking about 6 figures, mid 6 figures, all right? And most of those loans belonged to one of the spouses. All right, so let's just put some numbers on it. Let's say $400,000 in debt, $350,000 belonged to one of the spouses, not the other. Now, this other spouse had much higher income, so they're able to help out with the payments for the spouse with the debt. One question I had to bring up is that, hey, if you guys work together, so the higher income spouse pays off the debt, a lower income spouse, it could be $250,000 under an accelerated payment schedule that might be 10 years. And one of the considerations you have to discuss is that your lifestyle might change as soon as that debt's paid off. There's a lot less stress, a lot more disposable income. Anything could happen. One thing that you learn from doing financial planning is that no matter how much you try to expect the unexpected, you'll always be surprised, no matter what, in terms of how things can change and how quickly. So divorce is an important consideration. I asked them, what would you feel about this pay down of debt happening and then you guys split up? How would you feel about that? Not that that's going to happen, not that that should happen, not that I want that to happen or anybody else, but that is a consideration when you're making a significant commitment to pay down a debt for a spouse. All right? You don't want this to turn nasty later when there's a divorce attorney involved and everybody's fighting. It can get ugly. And having these conversations up front, no matter how difficult they may be, is a great way to get ahead of that in many cases. So that's yet another aspect of financial planning that's important to take into account. It's not always the fun conversations they are able to have, but at the end of the day, sometimes it's just necessary. All right. So hopefully, I'm not even going to attempt to pronounce this name here, but that was helpful. And if you're sticking around, if you're hanging out, you got a question, drop it in the live chat. I don't bite. We're going to tackle it like we tackled all these other questions. All right. And I love to read you guys' comments. Also, if you're still sticking around, like the video, would you? I'm seeing the like count. It's making me sad. Okay. So if you're here, you're hanging out, smash that like button, destroy it. Let the YouTube algorithm know that we're talking about some good stuff here. All right. With that, we're going to move on to yet another question. This might be the last one of the evening, unless you rock stars drop a question for me in the chat that I'd be love to address. So this is a bit of a departure from the financial planning stuff. Let's switch gears to the accounting subreddit. This is where accountants complain about their lives, how terrible they are, and how much they hate accounting. But in this case, the question comes from Specialist Code 402 and goes as follows. Can I actually land an accounting job without networking? Let's read. I've recently switched into this graduate account program, graduate accounting, I'm assuming, some sort of master's, and I'm terrified of networking. There are many free networking events and office tours at the big companies. I've never networked before. I'm scared of attending these events alone. I literally don't know a single person. Someone told me that it's hard to land an accounting job without having a connection or knowing somebody in the company. Is that true? And can some introverts please share their experience, or if anyone has any actual tips to interacting with people or networking? This is near and dear to my heart because I happen to be, I know you can't believe it, but a huge introvert. All right. If there's anything about my personality, that's a true statement. Aside from that, I went through this myself. I went to an accounting MBA program, and in there were the opportunities to meet the big four accounting firms while the program was running. So KPMG would come down to campus and hang out. The recruiting portion of KPMG, that is. PwC would come by, Ernst & Young would come by, and so forth. And these networking events were how they started to get to know us students to make potential hiring decisions down the line. That was the very beginning of the foundation that was put in place so that these recruiters from these firms can start to understand who they want to take on from the new accounting class. And I can tell you that one of the major reasons that I went to the public accounting program at Rutgers, the PA MBA accounting program, was the fact that I knew that the firms, instead of you having to go to them, they would come to you and do these networking events on your home turf, so to speak. So that was the way, not a good way, not the best way, not an optimal way. No. The way that you would put yourself in front of the recruiters who would ultimately make the decision as to who gets to even start the hiring process at the Big Four. And I was like you. I was not confident. I was stressed out about having to meet these people. What am I going to do as an introvert? How am I going to make this work? Well, you can't avoid these networking events, all right? I'm just going to give it to you straight. You're going to have to get comfortable with the prospect of hanging out, having conversations, interacting to the point where these people get comfortable with you, they get to know you, following up with these people, asking them for business cards, and keeping in touch, because that is what's going to get you ahead of someone who didn't bother with any of it, who stayed at home. The competitive edge from these marketing events that you get in an accounting program is tantamount to your success moving forward as an accountant. I can guarantee you. So, what do you do? If you're shy, you're timid, you don't have the confidence, and you feel like you're scared, you have all these different emotions, well, I got some news for you. You're going to have to embrace the suck, okay? That is a term typically used in the military where they just say, hey, this isn't going to be a fun ride, but we have to endure it because there's a mission here that we're working to achieve. All right, so it's like ripping off a Band-Aid. You're going to practice. You're going to go to not only these networking events, but before these networking events, you're going to go to other events, be it a convention, the park, the supermarket, what have you. And you're going to set a quota for yourself that you're going to start. I know this is painful, but trust me, this may be the best advice you ever get. You're going to make a quota that every day you're going to start conversations with 10 people whom you've never met. You might be thinking Alex is out of his mind. Yes, I am. Because I know how powerful a tool this is, especially for introverts who hate it. If I could sit in my room all day as a kid and not talk to anyone, I would. But to get ahead in life, you're going to have to work with other people. You're going to have to get comfortable with it one way or the other. So a great way to do that is to introduce yourself to 10 random people every day. Not 8, not 9, 10. And after a while, you're going to understand that it's not scary. They don't bite. No one's going to shoot you. No one's going to kick you in the head for saying, hey, how's it going? My name's Alex. How are you? Nice day we're having. And you'll see that there's nothing to it. Because here's the point. These networking events are not meant to gauge how smart you are. They're not meant to gauge how much you know accounting or how many details you memorized or if you know international accounting rules and how well you could put together a balance sheet. None of that matters. If you're in that program, they already know that you're going to learn that stuff. What matters is how well you can hang. What does that mean? They want to understand that if they put you in a room with 20 other auditors, which is very often the case, or 20 other tax preparers or what have you, that you're not going to piss everybody off within the first 10 minutes of being around you. All right? They want to know that you could be a normal human that's not awkward, that doesn't give people bad vibes, and that can maintain a conversation. And the best way you can achieve that is by being yourself. It's a fact that you're the best at being you. All right? I'm not here to talk about some crazy motivational nonsense, but I'm saying that only you can be you, right? That means that you don't have to try to be somebody else. You don't have to try to be someone you're not. Just go in there and relax. Have conversations like you have conversations. Because again, if you go in there with 15 bullet points in your mind and 20 facts that you memorized and all these accounting rules and you start spouting all of those, people are going to get freaked out because they're thinking, this person can't hang. And I wouldn't want to be in a room with this guy for 10 hours at a time working through tax returns or working through an audit. No way. So they're not going to subject the associates at that firm that you're trying to get into to having a deal with you if you can't hang. All right? Another thing you can do is ask friends and family to just practice conversing about whatever. All right? Just improvise. All right? Just say, hey, buddy, I need to get better at talking to random people. So just play the role of a random person. Let's have a phone call. Let's have a conversation even better in real life. Just play the role play. All right? Do it 10 times. You're going to get better every single time. And you're going to notice that the awkwardness is going to melt away because, again, it's a natural thing for you to be you. So the less you stress about it, the less you're coming into it without having practiced and worked through it. I'm telling you, introduce yourself to everybody. Start talking to everybody. They're not going to bite. Often they'll love the fact that you even reached out because a lot of people are afraid to talk to other people. And if someone came up to them on the street and said, hey, how you doing? What's happening? It's not the end of the world. Embrace the suck. Pull that Band-Aid off because you have to kill it at these networking events. Otherwise, you're not going to make it because they're going to pass your resume along. They're going to see a resume from a name that they recognized from the event, and they're going to go with that person. They're going to say, let's schedule an interview with that guy, not some random resume. I never met the person. I can't put a face to it. And that's how you'll be successful. All right. So even though it's scary, even though it's painful, you got to do it. And I guarantee you, once you go to a convention, once you talk to 20 people on the street, once you have 3 sessions with your friends and family of just interacting about everyday things, you're going to be set for success. I tell you that. All right? Okay. The other thing I will add to this question, and we're going to cap it off in terms of this item right here, is that you have to follow up. All right? When you meet somebody, that's one impression of you that they get. And then they can forget about it because they're going to see 500 other people, these recruiters. You want to make it like billboards and advertisements that you see over and over and over and over again. How many times have you seen an advertisement once and you're like, I don't care about that. The second time, I still don't care about that. The 15th time, you're just like, it might be kind of interesting. And then the 30th time you see the ad, you're going, what is this thing? Let me just look this up on my phone, right? That's the power of repetition. And when you're at these networking events, you better be damn sure to get a business card from each one of the people you meet. I don't care if you meet 5 people from a single firm, you get all their 5 business cards. And then what do? You send them a personalized email to follow up and thank them for the interaction. Say, hey, it was a pleasure meeting you. Thank you so much. I look forward to starting the process in terms of recruiting at your firm. I love the firm because of this, that, and that. That, again, triggers a memory. And that could be the second view that they get of you, and that makes them more likely to remember who you even are. You got to follow up. I'll give you an example. When I was going through these networking events, I remember that one of the recruiters, I don't even remember which firm she was with or what her position was exactly, but one of the representatives from the accounting firm, a Big Four, was at the networking events, and she was talking about her dog. And this was a Labradoodle that she was describing. Why do I remember that? Because this is about more than a decade later. The reason I remember it is because in the follow-up email, I said something having to do with a Labradoodle. Because as soon as I finished the conversation, on the back of her business card, I wrote, woman with the Labradoodle. And made sure to mention that in the email. Following up, again, a little bit of work goes a long way. And I still remember it to this day because I made sure not to forget that little tidbit when following up with this individual. And I could tell you that it did help in terms of the overall process. I didn't end up working with that firm, but I did start the process. So it had to account for something, right? All right. Hopefully that helps answer the question. And there's another question here from Soccer League Network. Let's take a look. We're coming up on the hour here, but we're going to do what we can. Now, on upon first glance, I don't know what we're talking about, but let's take a look. So can you talk about the right way to implement the Augusta rule? All right. I have no idea what the Augusta rule is, but let's take a look and see if we could Google it real quick. And this better not be some vile thing that pops up on my live stream. You know what? I'm going to do it off screen here and see what we come up with. See if I could help. All right. So allows homeowners to, okay. All right. So this is not some vile thing. The Augusta rule, known as IRS section 280A, allows homeowners to rent out their home for up to 14 days per year without needing to report the income on their individual return. Okay. So this is something that I will have to research a little bit and potentially save for the next live stream because my voice is about to go out. We got pretty passionate over here. But again, thank you guys for stopping by and joining the Efros Financial Power Hour. This is going on every Wednesday, 7 p.m. Pacific time, 10 p.m. Eastern time. Bring your friends, spread the word because this is only going to get better from here. I promise you that. Subscribe to the channel, like the video. I know a lot of you aren't subscribed. It's free. Completely abuse that subscribe button, would you? It's not going to hurt. And like the video, leave a comment down below. Love reading your comments. Join me next week on Wednesday at 7. We're going to have this powwow yet again. And as always, hopefully this was helpful. Thanks for watching.